Question: if you have highly appreciated company stock inside of your 401k, why should you not roll it into an IRA? Answer: because of the net unrealized appreciation rule, NUA for short. This allows you to move that same stock into a brokerage account and potentially pay lower capital gains tax rates instead of the higher ordinary income tax rates that can be up to 37% that you'd pay inside of an IRA. I'm Adam Olson, a CFP, and I've used my 14 years of experience to create the Red Zone retirement planning process so that your retirement feels like a Saturday every day. Here's why this strategy matters so much. Let's say you have $500,000 worth of company stock inside of your 401k plan, and your original cost, or the basis, your contributions, is only 50 grand. Now, if you roll that stock into an IRA and you want to take out money from that IRA, the entire 500 grand is taxed as ordinary income. And if you're in a high tax bracket, that could be brutal. But with the NUA rules, using this strategy, you can move that company stock directly to a taxable brokerage account instead. And here's what happens. You pay ordinary income tax only on the basis or your contributions. The remaining 450 grand in this example is taxed at long-term cap gains rates, not your ordinary income tax rates. And if you're in the 37% income tax bracket, this one decision could save you thousands of dollars over taxes, sometimes even a lot more. Now, here's where this fits into your bigger retirement picture. In retirement, there are 3 types of money: always taxable, sometimes taxable, and never taxable. The always taxable are things like your pre-tax IRA and 401k. The sometimes taxable is brokerage accounts. The never taxable is your Roth. NUA helps you intentionally create sometimes taxable money. And if your income is low enough in retirement, you may actually be able to sell some of the gains from this in the future and pay little to no capital gains tax at all. This gives you flexibility and control. Pro tip here: if you're legacy focused, there's another huge win here that you need to know about. The brokerage account stock now sits in a brokerage account. And remember, because this stock now sits in a brokerage account, your kids could actually receive a step up in basis in it when they inherit the account, potentially wiping out decades of built-in gains. This is one of those strategies that only works if you know if it exists, and only if it's done before the rollover. If you still have questions, just click the link in my bio to schedule a free introductory call.